Today's video is going to be a little different. Instead of analyzing a company through its financial health and delivering a bull and bear case, I want to talk about this particular company as a skeptic. By now, you've probably heard of Tesla, considering all the media fanfare around the company and its illustrious CEO, Elon Musk. You'll know Tesla makes electric cars and much more. So in this video, we're not focusing on Tesla's numbers, but instead some reasons why you might want to avoid Tesla for now. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. By this point, Tesla should be a fairly well-known company. Making waves over the last few years, the electric automaker released various models of its cars like the S, the 3, the X, and the Y, all to a lot of media fanfare. The company's stock has also been on an impressive ride, hitting an over 700% increase at one point last year in 2020. Throughout most of 2021, though, we see Tesla hasn't had the same success, despite its current exponential growth and current media attention. There are plenty of reasons, I'm sure, and I will attempt to explain some of them, but to get to the point, let me lay some groundwork. As many of you who watch my channel know, I am a value investor. Specifically, I like beaten up companies that have been rejected as failing or dying. For example, lately I've become a bigger and bigger fan of Bed Bath & Beyond. I own Intel, Sprouts Farmers Market, and Bristol Myers Squibb in my portfolio. In other words, companies that have seen less than stellar performances recently. With that said, I want to present 3 ideas about Tesla's stock that you might not have considered before. I imagine there will be a good few who may disagree with me, and that's fine. Feel free to dislike this video, but before you do, at least humor me. I want to make very clear that I love Tesla as a company. In fact, I wish to own my very own Tesla someday. The company's cars look good, prove useful and clean, and integrate incredible technology too, especially the latest version of Tesla's current lineup. But, and as my first point, their technology isn't unique. Something I hear from investors trying to justify buying Tesla stock is that Tesla is not a car company, it's a technology company. They'll even claim that being a tech company allows Tesla to be valued differently and trade at much higher multiples typical of other tech giants, as opposed to car manufacturers. Given that 83% of Tesla's revenue comes from cars, I find this claim odd. It's safe to say that it's predominantly still a car company. Plus, Tesla can't even turn a profit on these alone. No, it needs generous regulatory credits and Bitcoin sales to do that. But let's humor those investors who claim Tesla is a tech company for a minute. Let's actually look at the tech. Tesla's tech is centered around 3 main parts: self-driving tech, battery tech, and solar tech. Pause for a minute. Is any of this tech so unique other companies can't replicate it or outpace it? I think the answer is no. First, targeting Tesla's self-driving tech, I can't even count on 2 hands or feet the number of other companies that are building either self-driving cars or the technology to support self-driving cars. Take for instance the company Aurora. Founded by Drew Bagnall and Chris Urmson, Aurora is a company developing what they call self-driving 2.0 in an albeit uglier way. Interesting to note, Drew Bagnall used to work for Tesla's self-driving tech team as its head until a disagreement with CEO Elon Musk killed that friendship. And Chris Urmson used to work for Google's self-driving tech team as head of technology. To say they know the technology is an understatement. As for Tesla, losing Drew Bagnall as an incredible engineer was a hit in many ways. He took a skills, knowledge, and vision with him to create a capable rival to Tesla's self-driving technology. While Tesla might have the advantage in the self-driving sector now, that may not always be the case, especially since Tesla has only really implemented the tech into its cars. Other self-driving tech companies are designing the technology to implement it into every vehicle. What happens when a company with way more cash starts pumping money into one of these rival companies? We can see it already happening with Intel and Mobileye. Even though the latter company is fairly young, Intel and its billions own it. Those billions could easily power Mobileye's technology and development. All Intel has to do is sign off and it's done. And then Tesla will start sweating. Its advantage could simply vanish. Even though self-driving is just one segment of the technology argument, I think this same logic goes for the other parts too. Any area in which Tesla competes just can't be number one. A different company focused on any of these specific areas CEOs could simply come along and usurp Tesla's lead. Right now, I'd wager that lead is probably large, but as many companies turn their focus to electric, to battery power, and to solar, that advantage, I'd wager, will dramatically shrink. The second argument is one of valuation, an argument I'm sure many have heard before, however, with a twist. Even if the ultimate Tesla bulls gain the magical ability to always be right, that Tesla increases their lead infinitely, there is still a chance that they can lose money. Hypothetically, let's say Tesla grows its revenue by 40% annually every year for the next 10 years, which, by the way, is most likely impossible. Also, Tesla improves its margins by a few percentage points for a slightly market-beating return. The company would still be overvalued. Using the calculator over at Everything Money, we can calculate some of these numbers. Assuming a 40% yearly growth revenue for 10 years, less share dilution, higher margins, a reasonable price-to-earnings multiple, and a return that is slightly higher than the market average, this will tell us the price we would need to pay today, assuming all these hypothetical factors happen. The price to pay? Between $450 and $510. Tesla's stock as of this video is roughly $785. In other words, even in this hypothetical situation, investors are still massively overpaying for Tesla today. Let's illustrate this with an example and go back in history, back to the late 90s and the tech boom. Bear with me, I have a reason for taking you here. 3 companies are poised to dominate the world with their technologies. One is going to build the infrastructure to power the internet. The second is going to provide the parts to build the computers that will allow everyone around the world to connect to each other. The third is going to be the largest telecom company in the US for decades to come. Take a wild guess at what these companies are. Hint, I've covered at least 2 in past videos. You guessed it, Cisco, Intel, and AT&T respectively. The weird thing though is they did exactly that. Cisco is still the largest producer of internet infrastructure, Intel is still one of the largest producers of computer chips around the world, and even AT&T is still the largest telecom company in the US. Cisco even hit an all-time high of $80.06 on March 27th of 2000. But there was a problem. The underlying company just couldn't justify the price investors were paying. An easy comparison is price to sales, since this tells us how much a company makes in revenue relative to its market cap. Cisco maintained a market cap of around $400 billion for most of 2000. That same year, the company brought in just under $20 billion, giving it a price to sales of just over 20. Tesla's current revenue as of the end of 2020 is $31.5 billion, against their market cap of $762.7 billion, meaning Tesla's price to sales as of right now is 24.1. This is also after dropping nearly 30% over the last couple of months. Okay, so that was a lot of numbers, but later on in the video I'll go more in depth and talk about price to sales using the example of a laundromat. Believe me, you'll understand later. If you had bought the hype that day and continued to hold stock from Cisco in 2000 to today, you would still be down 30%. Even though the company would quadruple revenue, quintuple net income, and free cash flow, you'd still be a bag holder down 30%. Why? Because at the end of the day, one of the only things that matters about a stock is valuation. It almost doesn't matter how good a company is if you overpay massively for it. What's the point? This is the same story for many companies of the time, not just Cisco, Intel, or AT&T. Simply put, just because a company can change the world and be the most revolutionary company in history doesn't mean that you're actually going to make money on it, including Tesla. This goes back to the valuation argument used by the dusty old value investors. Respectively, many of these 90s companies were overvalued and eventually corrected. Even Amazon suffered a 97% drop back then, with many of the other tech companies literally dropping to zero. Investors lost everything betting on technology, innovation, and the internet. This same thing could similarly happen to Tesla, because remember, the market will always eventually correct itself. Not that I'm saying Tesla is poised for a 90% drop along with every other hype stock on the market. Tesla could very well be the absolute exception, performing better than expectations and reaching ARK Invest's magical $3,000 per share. How likely is that though? For this to happen, Tesla would have to become the biggest car company in the world by sales, and the biggest solar company in the world, and have the best self-driving tech, and become the largest insurer in the United States. If Tesla conglomerates and everything goes swimmingly for the company so much that it rivals the likes of Berkshire Hathaway in 5 to 10 years, then by all means go buy as much as you can. At that point, it would be a no-brainer. But most importantly, above all other arguments I've made, you need to separate the company from the stock, especially if you're an investor buying for the long term. If you're talking about revenue, balance sheet numbers, cash flow, and overall growth, you are, by definition, a long-term holder, not a trader. When you buy a share of a company, say Tesla for example, you're buying a piece of Tesla as a business. Many of you know this, but I don't think you fully realize what that phrase actually means. Essentially, buying a piece of a company is buying the right to a very small piece of its revenue, net income, free cash flow, and overall earnings as a business. The stock can stray wildly away from this base. This means that there will always be a right price to pay. What exactly that price is comes down to the individual, but I would guess that it would be as close to the company's free cash flow as possible, because ultimately it's the free cash flow that's paid out to investors at the end of the day. I would like to illustrate this using an example that I see way too often on Twitter. You come across a laundromat for sale. Once all expenses are paid, the laundromat's free cash flow is $40,000 a month. What's the right price to pay? $10,000? Well, you could reasonably pay off a $10,000 loan in a single month of operation with $30,000 of excess. So yes, $10,000 would be a phenomenal price to pay. How about $100,000? Would that be a good price to pay? After 3 months of operation, you could pay it off. So again, yes, that would probably be an okay price. What about $1 million? Is that still a good price? Well, maybe. In 2 years, assuming business stays consistently profitable, you could pay off your loan. Now, what about $10 million or $100 million? Can you see where I'm going with this? It's paramount that you're able to recognize that the stock price of any given company is not always reflective of the underlying business. If Tesla is a laundromat in our example with cash flows of $40,000 a month, then the stock price is the $1 million price tag. What do you think would happen if the laundromat would try and sell its business for $1 million? Well, I bet they would eventually have to lower their price closer to fair value. Then again, the other side of the argument states, oh, well, Tesla is growing. Yes, Tesla as a company is growing, sure, but the stock price has outpaced the actual company by a considerable margin. In 2015, Tesla reported $7 billion in revenue. At the close of 2020, it reported $31.5 billion, or an increase of 300% in just 5 years. Impressive. On the flip side, Tesla's stock price has spiked by about 2,000%. Would you say Tesla's stock price falls in line with that revenue growth, or say that price is justified? It's funny to think that one day I'll probably own shares of Tesla while making this case. It might even become the largest position in my portfolio, but not anytime soon. This won't be until far, far in the future when Tesla's fundamentals more accurately reflect the underlying company, assuming Tesla even lasts until the end of the decade. In the end, I want to reiterate, I don't hate Tesla. I hate investors preaching that Tesla is changing the world fundamentally and you need to buy the stock right now or lose out. Credit where credit is due. Tesla is changing the world in many ways, but you don't need to buy its stock because it's just so revolutionary. If your views on investing are similar to mine in that the goal of investing is the long-term game, I just don't think it's done by owning Tesla or Palantir or NIO. At least not right now. If anything, I hope you gain a new perspective on Tesla or think about some of the points I've brought up before your purchase. Even though Tesla had a phenomenal year in 2020 and is making waves, I believe the stock is still well overvalued. There are at least 10,000 other companies out there that I believe are a way better value. You should go out and look because you never know what you might find out there. Well, that's all I've got for you in this video about Tesla. I would love to hear about how I don't understand the technology or growth in the comments below, or have a conversation in my Discord, link in the description. Until next time, I will see all of you in the next episode of Dollars and Cents.